Okay. Um, what I have here in front of you is the answer key uh, that incorporates the change in the vendor payments. And as you can tell, um, we are, hold on, I'm sorry, we are now building cash flow. Starting with 75,000, we went down, but we're starting to, with our profits, recapture our cash flow. By the end of the second month, you should have $78,000 worth of cash. By the end of the third month, you're back up to $129,500 worth of cash. And a cumulative profit, by the way, of $119,000 for the first quarter. Okay. Now, a couple of things that we want to do to kind of give you another sense for how to look at financial information. To start with, the book talks about ratios, and you're going to be responsible for understanding how those ratios are calculated off a financial statement. And I'm going to do one just to give you an example of that, and then we're going to talk about break-even analysis. What is the minimum amount of revenue under this model that I can sell to break even? And that should bring us through most of the chapter material and give you a good, solid, fundamental understanding of the financial forecast, financial models, and accounting and how that works as opposed to cash flow. But let's just take the following ratios that you'll be responsible for, but just take a look at some things here. Obviously, let's deal with the first month. First month, cost of goods sold is $60,000. Everybody see that? What's the gross margin of the business? Well, the gross margin is the $100,000 less the cost of goods sold. So the gross margin would be $40,000. That is not your operating profit. That's your margin before you pay all your administrative expenses. That's what that's all about. So I'm giving you some terms of art that you need to be aware of. Now let's go to a ratio here. Here's one right here. Well, let's start off with current assets. Current assets for the first month are what is owed to you immediately and what do you have in cash? Well, we have $156,500, these two amounts combined, in current assets, cash and accounts receivable, against what do we owe immediately? $60,000. So we have $156,500, if you will, ultimately available for payments, and we only owe $60,000. So if you were to take that and take a look at what the current ratio would be, we've defined our current liabilities as our accounts payable. Our current ratio exceeds 2 to 1. So we know we have twice the amount of assets that are cash or near cash to compare against what our near cash obligations are. And that gives you a sense for what you're looking for in a company. If you have more than enough current assets over current liabilities, then you're going to have a very high current ratio, and that means your ability to meet your payments in the early days are positive. And we certainly have that in this scenario. We certainly did not have that in the scenario before we renegotiated with our vendor. So let's take a look at kind of where we are after this. And what I'd like for you to do, and we'll talk about what your assignment is going forward, but I would also encourage you to go back and practice both the cash flow positive and the cash flow negative scenarios in preparation for the test. Now let's look at the concept of breaking even. Okay. What we want to know is under this scenario right here. Let's take the first month where we sell 10,000 units are sold at $10 a unit. We have $2 a unit direct materials costs, $3 direct labor costs, and we have certain fixed costs. What we want to understand is what is the minimum amount of sales that Glak Love has to have before it can get into profitability. And what I want you to do is this is involved the concept of understanding what fixed and variable expenses are. And what we're going to do is go through and identify what are the fixed expenses and what are the variable expenses, learn how to calculate what break even is, and then be able to prove that to ourselves using the financial model that we have. So the first thing is we have $10 per unit coming in. Everybody understands that. If I sell one unit, I get $10 a unit. Now, what costs come directly out of that unit? Do the manufacturing costs come directly out of that unit? In other words, what's directly tied, what costs are directly tied to the units are not the fixed manufacturing and material. We're going to pay $10,000 a month whether we sell a unit or not. We're going to pay our $10,000 a month for all of our salaries, whether we sell a unit or not. The same thing for advertising, office rent, insurance. So what we're looking for are those costs that are directly associated with the unit. Well, that is $2 per unit and $3 a unit. So if you think about it, what we have is $10 a unit coming in, and we have effectively $5 a unit going out for a total of $5 a unit to pay off our fixed expenses. And what are our fixed expenses? Our fixed expenses are $10,000 a month plus $18,500 a month, or $28,500 a month. So let's go down to our break even. How many units would it take us to cover our fixed expenses of $28,500? And the answer is for you to take $28,500, which is the amount we would have to write checks for, and you need to divide that by $5 a unit, which is how much is left over after we pay our variable cost, and the answer is 5,700 units. So if you take, remember, our cost of $18,500 plus our cost of $10,000, let's go back up here to the first month, $18,500 plus our $10,000 rent for the machinery is $28,500, and we're dividing it by 5, and what you end up with is $5,700 units is how many units that we need to break even in our first month. So let's go test that. Well, if we're going to sell 5,700 units, right, our revenues would be $57,000. If we're going to sell 5,700 units at $2 a unit for direct materials, we're going to incur $11,400 in direct material costs. If we're going to sell 5,700 units at $3 direct labor, we're going to have $17,100 worth of costs. And of course, there's our fixed rent, there's our salaries, there's our advertising. And if we take $57,000 in sales, we now have $38,500 worth of cost of goods sold, which exactly means that our gross margin is $18,500. That's enough to pay off our operating expenses, and our net profit is 0. So effectively, the very beginning of understanding whether you should launch into this business would be, if I can't sell 5,700 units a month, I'm not going to make any money. What is interesting to understand is if I sell 5,701 unit, then I need to know what, that's when I start making profit, is after 1 unit. So now, let's kind of summarize this case and these exercises. Why it's not important for those of you students that end up starting businesses and working businesses to become accountants unless you decide that's going to be your career. It is important for you to understand the financial statements prepared by accountants and understand the opportunities you have by understanding the details of an economic model, how to test your decisions. Think about the scenario where Angeline would be sitting in front of a department store and she's negotiating a price, and they go, "We'd like to put your units in our store and test them." And Angeline goes, "Well, in order for me to do that, I've got to sell them at least 5,700 units at $10 a unit in order to break even." So she has that information because she's tested that scenario in her financial model. She knows anything above 5,700 units means she's profitable. They agree to do 10,000 units. Okay. The second thing is they tell her they're not going to pay her for the next month. So she knows that if she can not get financing from friends and family, or she can't get financing to plug that gap with a bank, she's got to turn around and take the fact that they've now agreed to go to 20,000 and 40,000 units in the third month and go back to her contract manufacturer and negotiate the fact that she can be very profitable even though she dropped her selling price by the third month. If she effectively can make money, she's going to have to fund that through asking her contract manufacturer to allow her to pay a month later from the time they produce their goods, creating a receivable on their books and creating the financing through the vendor. So that's the purpose of an economic model. That's the purpose of understanding this whole notion of understanding what that balance sheet is going to look like in the future so you can determine how you set up your financing. That's why you need to look at break-even analysis, and that's why one way of analyzing these things is to look at ratios to determine whether the business is viable going forward or not. So in summary, we need you to complete the ratios as part of your case study assignment indicated on the worksheet, be able to understand what those terms are and those couple of ratios that we have in there, and calculate for the first month. Here's what we want to know. How much profit would Glak Glove make if it sold 5,710 units during its first month of operations? And with that, again, I encourage all of you to collaborate. This is an area you need to practice because the test that will be given this week will include these types of calculations and these types of scenarios. So you need to be able to understand how to make these calculations on the test going forward. Good luck.